Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Rob Morris. Rob is the Global Head of Consultancy with Cirium Ascend, and he's joining us for the purpose of our Aviation Leaders Report 2024. I should say we're recording this in late November. Rob, thanks for joining us today. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Cirium Ascend?
Yeah, sure. Thanks, Joe. Well, first of all, thank you for the opportunity to be here with you today. So Cirium is a leading aviation analytics company. We've got lots of data sets, whether they be schedule, tracking, fleets, values and lease rates. My team in the consultancy piece of Cirium Ascend revolves around that last piece. We're primarily appraisers. About 3/4 of what we produce into the market is about values and lease rates. The rest leverages those data sets to produce opinion around supply, demand, the dynamic, all that kind of thing, program driven, largely around the asset itself.
Perfect, right? And I think we're going to touch heavily on the asset values and lease rate factors as we chat around it. Before we maybe go to that area, can you talk to us a little bit about airline customer performance, what we've seen over the course of 2023, and just how that's broken out from the key geographies?
Sure. I mean, I think airlines have had a great year. Airlines have had one of the best years they could have had. And bearing in mind this is the start of the next, effectively, growth cycle, that's a bit surprising. If you look at their finances, you think about in the US, the operating profits we've been seeing there have been very strong. Although right now maybe things are changing a little bit. As yields are starting to weaken a bit in some of that market, as costs are starting to bite because we've seen some significant labour contracts there, I think the US has probably had its best year. If you look at Europe, it's been really strong. Europe's all about constrained supply, allowing airlines to leverage revenues and yields. Now, yields are up significantly, ticket prices are up. I must say they're a bit overstated. If one looks at US CPI, 20% since 2019. Transatlantic yields are probably up around 15% in nominal terms. So in real terms, they're down a bit, but they are up. It's the reality that inflation is driving prices higher. That means that European carriers with constrained capacity and price control are doing really well. In Asia, recovery not quite complete yet. China's very difficult to read. The numbers are never really particularly reliable. But certainly in China, domestic market strong, international market not coming back yet. Their airlines are probably going to do better next year. Again, other Asian airlines lived on cargo through 2022. They're seeing passenger revenues come back. They've done pretty well. Overall, IATA in their last review said that they thought airlines would make around $22 billion operating profit, around $9 billion net profit. We think airlines this year will record globally an aggregate of close to $50 billion operating profit.
Yeah, which is remarkable when you think where we've come from in a relatively short period of time post-pandemic. And as you look forward then, Rob, and you assess kind of macroeconomic challenges and geopolitical challenges, what do you think are the key risks looking at the airline market?
So first of all, macroeconomics, if I think about all of the indicators we look at, whether it be GDP growth projections, whether it be the composite leading indicators, the PMIs, etc., they're signalling concern. But they were signalling concern 12 months ago, they were signalling concern 24 months ago. I think last year we were all worried about recessions in the developed economies. We've seen slow growth, but we've seen growth. We haven't seen recessions yet. I think the predictions are for growth globally to be between 2% and 3% this year. We see our predictions are for slightly slower growth next year, but still growth. And in the context of those macroeconomics, that's a positive. China is a concern. China predictions of Chinese growth are slowing. The Chinese economy is starting to look inwards as they think about their political policies. So macroeconomics, worry about China, whether it can be as significant as it were in the past, because we all think that China was going to be 20% of future demand. But overall, not too concerned about macroeconomics. Geopolitics are what they are. The risk has always been there. We'd kind of, I think with the pandemic, perhaps forgotten about geopolitical risk, and then Russia and Ukraine very rudely woke us up and made us think about it. And the now evolving conflict in the Middle East has some risk, but I think overall we are not massively concerned, and we think that we're into growth again for next year.
And as an appraiser, when you look at that macroeconomic thing, how much do you hone in on oil price? How much are you saying, well that's the key driver? Is that one of the main components as you're thinking values?
So oil price is a key component when we're thinking about base value. Very quickly, I'm sure people are familiar with market value and base value. Market value is the spot, really supply and demand driven. Base value is much more the long-term underlying economic value of the asset. It's algorithmically estimated, and one of the key variables in our algorithm is the change in fact, it's the change in fuel price. And oil price has been very volatile, and for airlines it's 30% of their costs, so that's a big issue for them potentially. But right now it's been easing. For us, when we're thinking about our base values, the longer term, we're really thinking about ESG issues there, the stringency costs of burning that fuel, because in reality it's not going to be the underlying oil price or the refined Jet A1 price, it's going to be the Jet A1 plus the cost of burning and creating that CO2. So that does model into our future base values.
Yeah, and I might come back to ESG in a moment, but honing in on the supply side. So we mentioned airlines are doing well, demand is there, it's held up reasonably well on the pricing side. Huge challenges on the supply side. Can you talk to us about your perception of how the OEMs are delivering assets and how the production rates have evolved, particularly in the context of maybe where they were 18, 19 versus where they are now?
Yeah, I think supply side is the issue right now. So if one thinks first of all about the OEMs and their delivery aspirations, and step back actually to 2018, as you say, in 2018 we had Airbus effectively ramping up towards 63 A320 family a month, and we had Boeing ramping up to about 60. And then, of course, the MAX issue hits, and in 2019 we don't have MAX. That's a dislocation. That did create some issues in 2019, and we can talk about how airline utilisation of single-aisle aircraft that were in service was higher than it had ever been, as airlines were able to leverage some higher yields because capacity was constrained a bit there. There was a bit of a microcosm of what we're seeing today. But then, of course, the pandemic hit, and Airbus, who were telling their supply chain and themselves to go to 63, suddenly went, oh no, we meant 30-something, not 60-something, so let's all slow down. The pandemic eased. Airlines who had over-deferred said, oh, we need the deliveries again, and Airbus had aspiration to get to 75 in 25. And of course, the reality was the supply chain was broken by then. It wasn't able to deliver. There's 1,000 suppliers in that supply chain plus, and each one of those had their individual issues because they'd been damaged by the pandemic. And that's what's driving Airbus and Boeing, with its own manufacturing issues as well, to struggle to achieve their rate aspiration. That's a big issue for airlines because they need certainty of planning their fleet plan. So right now, the slower deliveries we're seeing, even this year, frankly, where Airbus are projecting 720, I think it is, I'll be surprised if they make 720. Last year, they said they were targeting 700 originally, I think it was. They made 650 in the end, so, and argued it wasn't material. So there's going to be a slow recovery.
How does that compare to the 2018 number if you say they're getting to 700 odd?
I can't remember the exact number in 2018, but 2018 volume won't be achieved until 2025.
Okay.
We thought 2024, but between Airbus and Boeing, I think it was around 1,400 or so in 2018. It's going to take until 2025 probably to get to that number.
And we probably have a couple of thousand aircraft that were never made, right? And will never be
made.
There
are more. I mean, if you look at our projections from 2018, there are more than 3,000 single-aisle aircraft that were never made. Now, a lot of those the demand didn't exist for. But if I even step back, we've done a piece of work that looks at what did we expect to happen in 2022 for the period 23 to 27, and there our recovery scenario, our capacity recovery scenario was pretty robust. So the traffic and the demand we expect to see, we think will happen. But from that forecast we made in November 2022 and what we now think will be delivered today, there is still a structural deficit of single-aisle aircraft largely that exists through 2027. By the time we get to 2027, Boeing will have delivered a couple of hundred fewer MAXes than we expected them to deliver just 18 months ago. And likewise, Airbus will have delivered about 100 fewer A320 and A220 aircraft than we expected then. So there's going to be this deficit of new production for some time. It's less bad on the wide body side, but there's still a deficit through 2025.
And maybe that brings us on to values, right? So increased demand, constrained supply, values go up. But can you talk to us maybe if we break the market out into segments, and let's start with the shiny new tech. So when you're looking at MAXes or you're looking at NEOs, can you talk to us what we're seeing from a valuation perspective and that side of the market?
Absolutely. So NEOs didn't actually take a massive value hit during the pandemic because as airlines, there was a couple of months when there was very limited capacity being flown, but recovery started to happen in 2020 in domestic markets. And of course, airlines wanted to apply their most efficient aircraft to the networks. So the NEOs were in service as soon as they could be. And then when MAX was able to return to service, that also came back. So NEO and MAX didn't take a massive value hit. And if I look at the MAX, have taken a bit of a value hit in 2019, but if I look at where the values are today compared to where they were in 2019, they're almost back or slightly above where they were for the new tech. For the older tech, there was more of an issue because on the single aisle side, certainly the CO and the NG, there were more aircraft, therefore there were more aircraft parked, therefore there were more aircraft parked even as the recovery occurred. So recovery of values has been a bit slower, and in the context of 2019, values are just about back to where they were on a fleet-weighted constant age basis.
And when you're assessing values now, like one of the challenges I guess we see is interest rates have shot up, and a lot of leases were probably locked in during COVID for a significant period of time when it seemed like a sensible thing to do, and it probably was at that time. When you're assessing values on a lease encumbered asset, just how big a drag is it where you've written a lease in a low rate environment, and here we are now in a much higher rate environment?
Yeah, there's quite a significant drag there because, as you say, a significant number of the leases that are committed today were either written pre-COVID or restructured during COVID, and I think possibly now, if lessors had their time again and knew what they know today, they might have preferred to not force such a long extension of that restructured lease, because the opportunity today is to place aircraft into leases at much higher rents, and that will of course bring the lease encumbered valuations up. One other key point about the lease encumbered valuation is that the credit is a really important part. Our methodology discounts the cash flow by the credit risk of the counterparty. And of course, the counterparties have become more risky during the pandemic. So we'll see lease encumbered valuations improve as the credit worthiness of airlines improves, and as we see aircraft go into more leases with higher credit worthy airlines.
And maybe I'll move to lease rate factors in a second, but bringing it back to values, your perspectives on the wide body market. So we knew that long haul was slower to recover, but seems to be coming back in a real and strong way. Presumably that's having a positive bounce on wide body too.
It is, but wide bodies we need to take some pre-COVID context. So if I think about market to base value relationship, which is a great indicator of the balance of supply and demand, in the wide body market, again this is a fleet weighted constant age average basis of the entire wide body market remained below base for the whole of the last cycle. That's a really interesting place to be. I mean, typically it would be in equilibrium, it would be above base for some part of the cycle. So quite early in the pandemic, when we saw market values for wide bodies reduce even further, we realised there was a very limited chance that market would ever get back to base if we left base alone. So we had to impair base. We impaired base for 777-300ER quite early on. We impaired base for A330, not so fundamentally. But because we impaired, and because the market is now seeing a recovery, because the 777-9 is delayed, for example, meaning 777-300ER values are strong because the engine values are strong, because maintenance costs are so high, because A330 is recovering as Asia recovers, we are seeing market come back to base. And in fact, again on that fleet weighted average basis, market is close to base for wide bodies, which is a position we were not in the last cycle.
And maybe then bringing it back to the lease rate factor piece, your thoughts on how that's evolving? As I mentioned, we're here in late November. There's probably an acceptance now that interest rates are higher for longer, right? It's probably some of the phraseology we're hearing now. Demand being where it's being, supply being where it's being. How much are we seeing lease rates jump?
So I think with lease rate factors, there's a bit of a bifurcation going on between aircraft that are being placed, either used aircraft being placed, or more importantly, aircraft being placed from lessor speculative backlog, where I think there is an opportunity, given the supply and demand dynamic, to leverage higher leases, and therefore lease rate factors coming up. We're seeing lease rate factors higher there. I think the sale leaseback market is a little bit different still. There's limited supply of aircraft because of the OEM delivery delays, which means that there's a fixed amount of debt effectively chasing that sale leaseback market, and therefore the seller there, the airline, still has pricing power and can get higher price, i.e. values go up, but is still getting a lower lease rate because of the competition in that market. So a bit of a bifurcation. But I think more generally on lease rates, the supply-demand dynamic is going to continue to drive strength of lease rates for some time to come, particularly in the used market, where I'm sure we'll touch on the GTF issues later, but airlines are seeking durable assets that they can trust to be robust, reliable, and have known maintenance costs, which are effectively current generation NGs or COs. And in that context, midlife, I mean, I'd say 10-year-old is midlife, 10 to 15-year-old aircraft, are seeing rents now that are potentially 20, 30, 40% or more up over where they were even just 3 or 6 months ago. The market is moving really quickly upwards there.
Yeah, so a positive, I guess, if you have available lift, right? And
Absolutely.
some of the things as we're chatting to lessors, it's balancing existing relationships you have and the opportunities that are clearly there in the market. You mentioned the GTF. If we hone in on engines, another significant drag on the supply side. Can you talk to us about, from a valuations perspective, how you're trying to factor that in when we think about just the challenges that will be there?
Yeah, I mean, we're being asked lots and lots of questions, obviously, about what is the impact of the latest GTF issue on the engine on the aircraft with the engine installed. Is there going to be a delta between a LEAP-powered A320 and a Pratt & Whitney-powered A320? And the answer is it's too early to tell, actually, frankly. It's too early to tell because when we think about deltas between engine variants on the same aircraft, we need to think about liquidity deltas, we need to think about market share splits. Now we can see that LEAP is getting more market share seemingly right now, but it's too early in the program to tell. I think the other point is, I mean, we need to understand the fundamental impact this has on supply and demand. If one thinks about the number of engines that need inspection, 3,000 engines needing inspection, in RTX's own words, an average of 300 on the ground at any time, aircraft on the ground at any time between now and 2026. That's 2% of the global capacity of single-aisle aircraft. That has a fundamental potential impact, and of course at peak it'll be 680 next year. So that's driving positive value pressure for now, and frankly, even if you had a spare GTF engine, we'd see positive value pressure because people are seeking engines to lease to cover the 300-day downtime for that engine because they need the asset flying to generate revenue still.
Actually, bringing maybe to a macro point on that, with all these supply side issues, are we still forecasting growth? We've always talked about that 2-time multiple, right, in air travel. You've got the 2019 to 2022 major dip. Do you think all these demand challenges, does it impede us on an overall growth perspective?
I think it does. I think it does impact the potential for growth somewhat, but I think we still have growth because airlines were still, I mean, the fleet today in service is larger than it were at the same point in 2019. So we've been able to see some growth, and next year Airbus will deliver inevitably, I don't know, 760 or something, or 780 aircraft, and Boeing will deliver 600 or some. So between them they'll deliver 1,300 plus aircraft, not all of which will be for replacement because, by the way, people who were planning to replace will now keep aircraft for longer. I'm hearing of 24-year-old A320 family aircraft that were expected to be parted out that would probably go through another heavy check, another engine shop visit if you can get the slot, and return to service for a while longer yet. So we're going to see a delay of retirement, a frustration of retirement. That will enable the growth, but it will still be lower than we expect. That's a positive for airlines because, frankly, again, supply and demand, constrained supply, you can manage price upwards.
And maybe touching on a segment of the market that during COVID was probably the star pupil, being cargo, where we had an explosion of e-commerce, a lack of belly capacity. Cargo was going really strongly, and a lot of people were talking about conversions, and a market that was performing really well. We've probably seen some challenges in that market. Can you talk to us about how that has evolved over 23 and your outlook into next year on cargo?
Yeah, sure. So cargo traffic was about where it were. It was neither up nor down particularly. Yields were up because supply was constrained there because we lost all of the belly hold capacity. Remember, before the pandemic, 50% of cargo capacity came from belly hold. So we lost that passenger network, we lost that 50%. So supply was well down, hence price went up. Now yield is coming down, but yield is still above where it were in 2019, suggesting to me that although the latest IATA traffic numbers are not positive, although it looks like there is more supply than demand right now, it hasn't fundamentally broken that yield pricing model. So we see that. And then we've seen in the last couple of months the IATA traffic numbers returning to positive growth on traffic again. So we are seeing something. Now it's seasonality. We're in a period when traffic is always going to be strongest before Christmas and around Thanksgiving. But I think we're confident that there will be some growth still. Now, when it comes to conversion, we think about all those narrow body aircraft that were committed to conversion. That's because there was a change in the distribution networks, the fact that e-commerce became a significant part of the way we acquired commercial goods during the pandemic. That means we need a narrow body feed network that possibly we didn't need to be quite so large before. That's what's driving the 737 and the A321 conversions. I think whilst we believe there was an overcommitment, we think some people have pulled back. It's about appropriate. We do hear that lease rates have eased a little bit there, so we saw the positivity we saw last couple of years when we were seeing lease rates above 200k. Perhaps it's eased off below that a little bit, but not fundamentally broken. The concerns we maybe had of a surplus, a very large surplus of capacity coming into the market 12 months ago has not eventuated because of the passenger supply side issue.
And maybe shifting gears, Rob, and looking at the leasing market, your perspectives on that long-term trend of leased assets. So I've looked at interesting charts you guys have produced before where we have 1990 and we're 20% to where we are now. It's generally gone one way, sometimes with spikes. Can you talk to us about how that lease percentage evolved kind of post-COVID and just your perspectives on where that might go?
So first of all, it's an interesting one because you have to think about how you measure it. So the way I typically measure it would be to look at the number of passenger single and twin aisle aircraft in leasing management compared to the global fleet. And for sure, that's exceeded 50% during the pandemic. Interestingly, this year it's gone down by 0.5 percentage points. So I think the reason it's gone down is we're seeing, and we hear all of the lessor CEOs talk about the fact they're selling aircraft off lease to airlines to give the airlines certainty. The airlines want certainty of fleet and cost control. So when I looked at the numbers the other day, around 3 times as many aircraft sold off lease to airlines this year as there were in the same period last year. So that's going to drive a temporary blip downwards, but that's measured in units. If you measure it in value, so measured in units is about 52.1%, something like that today. In value, it's about 5 percentage points higher because lessors are typically owning
the new stuff.
Yeah, the newer stuff and the younger stuff. So if we argue, could it get to 60%? Possibly, because the reality is that lessors for a long time have been acquiring 60% of new deliveries. About 25% of new deliveries come to them through their own backlog, about 35% through sale and leaseback. That's good. Both of those are going to continue. Down a bit on the backlog side this year, but that will come back as we see lessors continue to take delivery of their backlog that was deferred during the pandemic. So I think it'll grow. I don't think it'll grow fundamentally. I don't think we'll see 60% in unit terms achieved any time in the next 5, 6, 7 years, but it will still grow incrementally after it's settled a little bit this year.
Do you consider, when you're thinking about from the valuation perspective or on the consulting side, the leasing market, we probably talked about expecting consolidation, and we've seen some, but maybe not as much as people thought a couple of years ago. When you're looking at that market and you think about consolidation, what are your thoughts?
Yeah, I think we thought there'd be more consolidation because we were expecting the new entrants in the back part of the last cycle who saw relatively cheap money, relatively affordable assets, relative ease of placement and management, and therefore an expected yield. Didn't see the pandemic, didn't see the threat that would have to their yield, and haven't seen the returns, and therefore some of those that grew to a scale that were in the 100 to 200 sort of portfolio size, with some backlog ordered as well, because that's what lessors did, have exited because they couldn't make their yield. But I think we thought we'd see more of those, especially from some of the newer entrants towards the back end of the last cycle. As I say, we haven't seen it yet. Now, some of those are still going to struggle to achieve growth. If I think about some of the lessors that entered the market in that back end of the cycle, that placed orders for aircraft that have now been pretty much delivered, but haven't been able to renew their backlogs in the same way that, say, SMBC, Aviation Capital have, or Avalon have, or all of the largest lessors have. They've all been placing incremental orders and still have a backlog, therefore. I think some of the newer entrants don't, and therefore they're going to find it hard to grow. So they're going to end up questioning in the first part of this next cycle their business model, I think, and we might see some more consolidation yet in 1-2 years' time.
Yeah, it kind of speaks to the value of slots at the moment, doesn't it?
Yeah,
you see slots are so constrained. One really important piece, as you say, you got the big guys who can do potentially probably large scale sale and lease back or have an order book. If we look at maybe the class below that, right, the non-IG rated lessors or the asset manager class, that's heavily reliant on trading. So you're into that secondary market. We've talked a little bit on values. The volume of trading that we're seeing, can you talk to us around what that market is currently like?
So the volume of trading is very clearly down. If I look at our Cirium database, it's very clearly down over where it were in the back end of the last cycle. It's showing a small tick up, but it's very small scale. I think that's logical. If you think about what is available to trade, well, the majority of the assets that are in lessors' portfolio today are either in leases that were agreed pre-pandemic or restructured through the pandemic, but in the first part when interest rates were still low, and therefore the financing was appropriate to the rent you could achieve. We've talked about how lease rates are increasing very quickly, and whilst a large driver of that is supply and demand, the other part is about interest rates feeding through to the new aircraft placements that need to get placed at that higher rent to achieve the same yield. We actually believed at the very first part, well, once interest rates started to increase, we believed that full recovery was not going to be possible. I think the supply and demand dynamic means it could be possible. But back to trading, it means that the majority of assets are in low interest rate leases, if you like, with high interest rate capital. If you want to trade and buy them today, that's going to be a challenge for some time to come.
Any gauge on percentage terms where we are maybe in 2023 versus where we were in 18, 19?
In the absolute portfolio, hard to tell, but I would imagine it's going to be a very vast majority in the sort of lower interest rate leases still.
Yeah, and maybe turning to another topic that is massively important, but I have some skepticism over the real impact it's having maybe on aviation finance, and that's across ESG. When I have lessors or bankers in your seat and we talk about what's it driving from a basis point perspective on debt or your pool of investors, the answer is honestly minimal, right? It's coming, but it's minimal. Can you talk to me about how you're factoring in ESG when you think about it from an appraiser perspective?
Sure. So first of all, I think the issue is perception right now. So the issue is that we have an industry that the world thinks is driving climate change, a significant contributor. We've got to be careful to make sure that the world knows that isn't the case, that we are genuinely wealth creating, we are a genuine part of the global economy, and we need to enable aviation to continue to exist. That's the very first important point. But then when it comes to the finance point, people go, well, I've got finance options here, one of which is aviation finance, and aviation is the industry that is, in inverted commas, destroying the planet. So I can't put my money there. When we come to think about that in the context of our valuations, I already spoke about how our algorithm uses the cost of fuel as a base value driver. So effectively, implicitly, we are penalising aircraft-based values for prior generation. The more effective aircraft that effectively burn less fuel have better base value retention, or should have better base value retention. That's what we're seeing right now, and that's how I think it'll play out in the longer term.
Yeah, and I think, as you say, as we potentially see more penalties, requirements to use SAF, all that thing is going to evolve, right, and come into on the value side. Rob, maybe in closing, looking back at the broader market, can you talk to us about what are your optimism levels like?
So I think for next year, I'm relatively optimistic. I think values and lease rates will continue to increase. I think that's because the supply side will be dislocated for some time to come. I think the macroeconomics and geopolitics we spoke about at the start are always a risk, but actually I don't think there's a fundamental risk in there. We haven't seen the impact of those over the last 2 years. For sure, I think to some extent we might see the impact of higher inflation start to make people question their travel decisions. But I think we've learned during the pandemic that travel is possibly one of our last great luxuries that we'll protect. And therefore I think I'm optimistic that 2024 is the year that global growth recovers. I think it's the year that Asia finally recovers back to 2019 volumes. I think it's the year that airlines continue to perform reasonably well, notwithstanding the cost issues I spoke about in the US. And I think it's the year, therefore, that lessors can place their aircraft at higher rents for higher returns because of all the positive pressures.
Well, on that positive note, Rob, I'd like to thank you for your insights and wish you and Cirium Ascend, on behalf of KPMG and Airline Economics, a very successful 2024.
Thank you very much, Joe, and thanks for the opportunity to speak to you today.